300 million Americans, you get a cocktail. And I think that's what's creating all this anger around the country. I know you don't run the Justice Department, and I know you don't vote on legislation that could address some of these other issues. But I think we got to say it as much as we can, because I don't think the world is hearing us. Now, I would like to yield now the remainder of my time to the ranking member of the Financial Services Committee.
Thank you very much, Mr. Cleaver. As you know, originally, all of this money that goes to these too big to fail banks, and trying to understand, number one, not only the fact that, for example, Goldman Sachs got 121 million, J.P. Morgan 910 million, and that with the rise in interest rates from 0.25% to 0.5%, this will double. And this money keeps, I mean, it's going to the big banks. It's a subsidy to keep them from lending money. And we have this big need that's being discussed by my colleagues about this high unemployment rate and the lack of creativity and thinking about how we could deal with this. And these banks, too big to fail, who we're finding every day because of the predatory lending, et cetera, are getting support from the feds. Please explain that.
It's an essential tool that we need to adjust the level of short-term interest rates. And from the standpoint of the taxpayer, our payment of those interest on reserves, we have very large reserve balances. We have $2.5 trillion roughly of reserves in the banking system as compared with 20 or 30 billion prior to the crisis. The counterpart of that on our balance sheet is that we hold a very large stock of assets on which we are earning a substantially higher rate of return than we are paying to the banks. And that differential between what we earn on our holdings of long-term treasuries and mortgage-backed securities and the 25 or 50 basis points we pay to the banks, that differential all shows up in the taxpayer's pocket. It is money that Congress can use to address all of the problems that you have discussed. Over the last year, we transferred $100 billion because of that. Now, if we don't pay interest on reserves and must use another technique to adjust short-term interest rates, likely we will be forced to greatly shrink or be significantly diminished. In addition to that, it would have very adverse effects on the economy.
Well, I want you to know that not only am I concerned, it looks like we're about to have some bipartisan concern on this issue. And while I understand the argument that you're making about the big banks, we cannot feel sorry for them in terms of the amount of interest rates, you know, that they are getting or not getting, et cetera. We really do have to deal with this issue. I understand what you're trying to explain by short-term interest rates, but if I may, Madam, let me just say this, that we have an opportunity with the discount window to allow for loans from some of these small community banks that they're not getting. And if that money went into the small community banks, they would be able to do job creation and to support small businesses, et cetera. And we just don't get why they are precluded from doing this and increasing the job opportunities in the community while we are given this subsidy to the big banks. We just don't get it.
Although I agree with much of what the ranking member has said, she has long since spent her time. The chair now recognizes the gentle lady from Utah, Ms. Love.